get here typically about 5:30, 6 o'clock, get everything all set up. Everything was set up, everything was going, and then I don't know, probably about 7 o'clock, all the power went out.
Oh.
Reset everything back up, and it was not easy. We'll get started here in just a couple of minutes. Good morning.
Good morning. Oh my God. This meeting.
All right, let's go ahead and get started. So today we've actually got some interesting little topics to get us through the day. So the first thing, let's just go ahead and start off with equity participation loans. All right. So if you recall, one of the things that we've talked about is that all lenders are not created equal in the sense of kind of how they may approach lending. And specifically, what kind of special arrangements that they might make with a borrower to be more of a partner than necessarily just a traditional lender. And one way that they can accomplish this is through the use of something that we refer to as
Dr. Forgay, I think you're on mute.
Really?
Yeah.
Let's see. What about now?
Yeah, I can hear you now.
Unbelievable. So the power went out earlier. I got here, got everything all set up, everything was up and working, everything was set the way it was supposed to, and then the power went out, so sorry about that. All right, well, you missed all the exciting stuff that we're going to talk about today, so we'll sort of...
He gave all the quiz questions.
Yeah. Okay, so, going back, equity participation loans. So one of the things that lenders may choose to do is get more involved with a project than just being a traditional lender. And one way they can accomplish that is through the use of equity participation loans, okay? What this means, in essence, is the lender can become your partner in a deal. And also, this is where you need to rethink what you think of whenever you think of lenders, okay? They may be a development partner that simply is searching for some sort of maybe a simple rate of return. They lend you so much money, charge you so much interest, and in that role, they're just simply a traditional lender. But what if they change that up a little bit, and in addition to just making you the normal loan, they also want to participate in the returns the property generates, okay? So for example, a lender might be given a piece of your net operating income. Above and beyond whatever the debt service might be, they might be given an extra piece of in essence, your sort of money, but in this case, it would flow to them. They might also participate in the upside whenever you sell the property, okay? And now, most of you would have to ask the question, well, why would you want to do that as a developer, as an investor? Well, usually, it may be tied to getting a low interest rate on the loan itself, but the lender more than makes up for it with respect to the money that they would get in terms of the little piece of your net operating income and the little piece of the upside on the resale of the property. Okay, does that make sense conceptually? Yes? Okay. So, let's try to go through and sort of explain how this would sort of work in practice. So let's just say, I don't know, we've got a $10 million deal. All right, once again, we're going to make the assumption 12 payments per year. And let's say that the base interest rate that they charge is maybe 3%. And this is for, I don't know, 20 years. All right? So at this point, nothing is new. We're going to calculate what our payment would be. Okay? So the monthly payment on this, $55,459.76. Okay, so once again, at this point, nothing new. Just a normal loan, got interest rate, got our term. Okay, now, this is the part where obviously it begins to sort of evolve and take shape. So the lender, they're going to get this, okay? Absolutely going to get this in terms of this is their monthly payment that they're going to receive, for 20 years during this project, okay? But in addition to that, they also want, let's say, 30% of annual net operating income. Okay, that's a lot. Especially whenever you consider that, if we remember kind of our operating statement, that you've got net operating income minus annual debt service gives us before tax cash flow. Well, here, this 55,459 represents what? Well, it represents the,
Even the
Debt
whole-
service.
no, it represents the,
Debt service, no?
Net operating income.
it represents the monthly debt service.
Oh.
So you've got to multiply this by 12. To get 665,517, 11 or 12. So that would in essence go in here. Okay. I don't have to actually do this little step that I'm doing right here. I'm just trying to illustrate what's actually happening. So we know that the lender is obviously going to require us, based on what we talked about last week, we've got to have probably some sort of a minimum debt service coverage ratio to make the lender happy, that sort of thing. So obviously our net operating income is going to have to be substantially higher than whatever we've got here, okay? Now obviously I'm just making numbers up just to sort of get us to where we're trying to go. But let's just say that I give you net operating income is, let's say, 1.5 million. Okay? Now, just for fun, what would that mean that our debt service coverage ratio would be?
Some 70% of the 1.5.
No.
550.
What? No. What would our debt service coverage ratio be?
2.25.
Yes. So our debt service coverage ratio is going to be like 2.25, because all we're doing is we're taking 1.5 million, or dividing it by the 665, 517, 12. Now, is that a good debt service coverage ratio?
Nope.
No, it's an excellent debt service coverage ratio. You're generating basically more than double the net operating income relative to what you're going to have to pay the lender. Okay? So that's an excellent debt service coverage ratio. Anything above probably 1.2, 1.3 is going to be good. Okay? We're going to be happy with that. So this is excellent. All right? Now, what we're saying in this particular case is the lender is going to get 30% of the annual net operating income. Okay? And once again, this is totally separate and apart from what they're already getting in terms of debt service. All right? So if they're going to get 30% of NOI,
450,000.
that is going to be 450,000. Okay, I'll just kind of do another calculation down here just for fun. So we've got 1.5 million times 30% would be $450,000 of basically additional payments to lender. This is an annual. Okay? Does that make sense, everybody? Yes or no?
Yeah.
Okay? Now, the lender's not done with you yet. Okay? So they're going to get that. Then they also say, you know what? We want a piece of whatever the property basically it sells for or is valued at some point in the future, okay? Could be that, it's over the life of the loan. Could also be over some sort of a predetermined period. Could be over 5 years. Could be over the whole life of the loan after 20 years. That's, once again, for you and the lender to kind of work out the deal on that. Also, just while we're talking through this, in terms of the annual NOI that they may get, it may be based on something else. Could be based on before tax cash flow. Could also be a situation, instead of a flat percentage of overall NOI, it could also be above a certain threshold. It could be they get 30% above a certain amount. Like, for example, now this is not the case, so don't write this down. Just once again, this is just for you to think about. It could be the case that we said, okay, they get maybe 30% of NOI above $1 million. Okay, so instead of getting basically 30% of 1.5 million, they would get 30% of 500,000. Does that make sense? Okay, so there's an infinite number of ways this could be structured, is my point. Okay, so it's just a matter of you, once again, kind of interpreting what's being given to you and what's being asked to kind of go down the road of figuring out what you've got to obviously calculate. Okay, so let's say that in this particular instance, what percentage of the capital appreciation maybe do we want to give them?
We don't want to give them
We don't want to give them anything, but what might we give them? Okay, so let's just say, all right, in this particular case, the original loan amount was $10 million. So let's say that we're going to give them 20% of sale proceeds above 10 million. Whoops. Now we could base it on the loan amount. We could also base it on the overall value of the property. So there's a lot of different ways we could sort of approach this, okay? But let's just say that we want to base it on 20% of the sale proceeds above 10 million bucks. All right? So, let's say, now, in terms of the sale proceeds, I could just give you a number, and I could just simply say, okay, the property's sold for $15 million. All right, so if that's the case, we would simply subtract out 10 million, which would leave us with basically 5 million in proceeds. And then we're saying the lender would get 20% of that, which would basically be $1 million. Okay? Does that make sense, everybody? All right? So now, the question would be, what sort of an overall return would the lender be receiving? Okay? Well, it's a lot easier than you think it is, okay, in terms of sort of setting this up. All right? So what we've got our annual debt service that they're going to be receiving. But first of all, okay, let's just start out with the beginning. How much is the lender giving us? 10 million. Okay, so let's start with that as the cash flow. Now we're going to do this on an annual basis. You're going to see why. Okay, so the lender starts off, they're going to give us $10 million up front. Then, each year, the lender is going to receive from us the $665, $517, $12 in annual debt service, plus the $450,000 participation payment. So that's going to be whatever that's going to be. Okay? They're going to receive that payment for how many years? 20, but really only 19, because the 20th year we've got to add in the $1 million. All right? So we're going to put in 19 years. And then the final year will be the 665, 517, 12 plus 450,000 plus 1 million equal, and then that would be the final cash flow. Then we simply would be calculating the internal rate of return or lender's yield. See what we get. Okay, everybody match up, 9.49%. Okay. Now, you could, because all of the cash flows were the same, you could have also set this up as what? Present value, payment, and then future value for the 1 million, and then 20 as the term, and you get the same exact answer. Okay, so you have the choice given that the payments are the same. Okay, now if they change from one year to the next, you'll be forced to get done what we just did. Okay?
And then why would you do it one payment a year? Just because you're doing the cash flow?
Yeah, well, you'll also, that 450,000 is an annual payment.
Right, okay.
And so you've got to figure out a way to slide that in there appropriately. Okay?
So I guess you could have done it with 12 payments a year, we just use the monthly numbers.
Yes.
Okay.
Okay. All right. Any questions? So what do you think about that?
Bankers are greedy.
Bankers are greedy. All right. Lesson for the day.
And it also seems to be good to be a banker.
Absolutely. As long as people are making their payments, it's good to be a banker.
Yeah.
He also thinking the next.
Okay. Moving forward. Okay, some of you may or may not have heard of wraparound loans, also called wrap loans, also called burrito loans. I mean, the whole idea behind this type of loan is you have an existing loan and you, as the borrower, want to borrow additional money on the property that you've already borrowed money on, but instead of having two separate loans that you're making two separate payments to, you end up getting, in many cases, what's called a wrap loan that basically encompasses both, okay? But the wrap lender doesn't pay off the other lender. And the idea behind this is that other lender may be at a low interest rate, could just be that the wrap lender doesn't necessarily want to have to front more money, so they, the wrap lender, basically take on the responsibility of paying the primary lender. Does that make sense? So, let's just kind of give us a scenario here. You maybe have an original loan for $100,000, all right? So let's assume, once again, 12 payments per year. Okay, so this is your original loan, $100,000, and maybe it was at 2% interest for 30 years. Okay, so your payment, so we'll start with that. Okay, so your original payment, whenever you got your original loan, we haven't talked about the wrap loan yet, so this is just the original loan that you got, independent of any future loan that you might get. Okay, so we got this loan, and maybe we got this loan 10 years ago, okay? But now we want to borrow some more money, all right? So the first thing we would do is say, okay, how much do we owe, all right? So in this case, if we got it 10 years ago, 10 years times 12 months in a year, 120 basically payments. So one input 120, shift, amortize, equal, equal, equal. Okay, so we still owe $73,064 and let's say 17 cents. Okay?
So this would be if it's asking how much do we owe after year 10?
Well, that's what we're calculating, but what the setup, which we're about to kind of get into, this is your original loan. You made this loan, you got this loan 10 years ago. Now, 10 years into this loan, you say, I need more money. I want more money as a borrower. So you go to a wrap lender, and the wrap lender says, okay, you will get to keep this loan, but we're going to wrap around it a bigger loan, okay? And that bigger loan might be, let's say, $200,000. Okay? So the wrap loan is, let's say, going to be $200,000, and it's going to be, let's say, for 20 years to kind of match the remaining term of the original loan, to keep things simple.
Do you have to put like a zero again? Do you have to clean out?
Yeah, you probably want to clean everything out because we're going to be changing things. Okay, so the new loan or the wrap loan, $200,000 for 20 years, and maybe the interest rate on this is 6%. Okay? So first thing we're going to do is just find out what the payment on this new wrap loan would be. Okay? So the new loan is $1,432.86 as a monthly payment, 6% overall for the entire $200,000. Now, hopefully, those of you that are paying attention and have been paying attention, this is somewhat similar to what we have done. What?
Refinancing.
Not
Adjusted rate?
Nope. incremental cost of borrowing. Okay? This is going to be somewhat similar to that. All right, so in this case, what's going to happen here is the wrap lender is going to agree to continue to make your payments of $369.72. Does that make sense? Which means they're going to pay off over the remaining 20 years the balance on the original loan. Okay? Now you're saying, why does the wrap lender want to do this? Well, the wrap lender is going to be in a junior position to that original loan. Okay? Even though the wrap loan is bigger, the original loan, by virtue of being first in line, if something happens, payments don't get made to that original loan, the property could be sold and the wrap lender walks away with nothing. Okay? So, the wrap lender wants to stay involved and wants to make sure the payments are being made to that original lender. Okay? Does that make sense? Okay? It's like getting, to a certain extent, it's like getting a second mortgage, but it's different in the sense, a second mortgage, you would just be making a second payment to the second mortgage. Does that make sense? Whereas this, you're just making one payment as the borrower. Okay? The wrap lender is going to make out like a bandit. Okay? Because, once again, they're in essence making payments on this original loan, and your original loan was at a 2% interest rate, but the reality is they're charging you 6% on everything. Okay, and they're getting to keep the difference on the original one. Does that make sense? Yes? Okay. So you're saying, what's another motivation for the wrap lender? Well, they can make some more money. Okay. So, let's look at the difference between the two payments. Okay, let's get the difference between those two. So you end up with the difference of 1063.24. Okay?
So is the 369 payment, is that already included in the 1432?
Yes.
Okay.
Okay? So here's what's happening. The wrap lender is going to be making the 369.62 payment for you. But the wrap lender every month is collecting from you $1432.86. So the wrap lender is getting to keep the difference of $1,063.24. Does that make sense? Yes or no?
Let me ask you a question. So is the wrap lender assuming the first loan?
No. They are simply making payments on your behalf.
But you're making the payment to the wrap lender.
Correct.
He turns around and he pays
Correct.
the primary loan.
Correct. They're just making sure they get paid.
Gotcha.
Okay? To a certain extent, it's similar to whenever your lender collects escrow payments for your insurance and your property taxes and that sort of thing. The reason they do that, they want to make sure the property taxes and the insurance get paid.
Gotcha.
Okay? All right. But in this case, it's a mortgage payment. All right. So the reality is the wrap lender is getting this as a payment. They are getting it for how many years?
20.
20 years.
you need to do plus minus for the payment?
You can. I mean, this is just depending on how you want to look at it, okay? And then, how much extra money is the wrap lender basically giving you? Anybody? So, in other words, the wrap lender,
127.
you take the 200 and you subtract out the 73,064.17. $126, $935, $83. And I'm going to put that in as a negative because from the lender's perspective, that's extra money that they're sort of forking over. Does that make sense, everybody? Okay? But then they are receiving, from the lender's perspective, $1063.24 every month. Now, so the logical thing that we're solving for is what? The interest rate or the lender's yield, or the wrap lender's yield, specifically. Rounded off 8.02%. Okay?
Wait, when you push the buttons here, where do you start? Do you re-zero at the...
Yeah, you just basically you just clear everything here,
Exactly.
put those in, solve for that. And so, in this case, the reality of the situation is the lender is making the payments on your behalf to the original lender. The wrap lender is making those payments of $369.62 on your behalf to the original lender. And then, but they, on the new money that they are lending you, the wrap lender is lending you, of the $126,935, the reality is, instead of really getting 6%, they're getting 8%.
Is it just a coincidence that the original loan is 2%, the wrap is 6%, and it's kind of 8%?
It's pretty much, yeah, it's not just coincidence, it's close enough that that's really what's happening.
Oh, okay, okay.
Okay?
Professor, when we're solving for the lender's yield in the last part, and we put 20 for our periods, and we're receiving a payment of 1,063, wouldn't it be that they're receiving 1,063 for 10 periods?
No, because keep in mind, the new wrap loan is for 20 years. The original loan was for 30 years. 10 years of that has gone, so what's left is basically the balance at the end of 10 years, meaning 20 years worth of payments remaining.
But the payments wouldn't increase to them to up to 1,432 after year 10?
No, it's a brand new loan. So your payment as the borrower goes up from $369 to $1,432 because you're getting an additional $126,000 from the wrap lender.
Well, no, I did that. I guess the reason why I'm confused about it is because 10 years has already gone by from the last loan.
Correct.
So I guess the way that I was thinking about it is that for 10 years they would be receiving 1,063, and then 10 years after that, since
No.
pay off the other loan.
No. Okay. All right. So, okay. So let's just go back and make sure that everyone is clear. All right, so what is happening timeline-wise? All right, timeline-wise, your original loan of 100,000 was got here at time period 0, all right? After 10 years, that loan has been paid down to 73,064, okay? So now, at year 10, you're getting an additional 126,935, or a total of $200,000 overall loan that then is going to be paid off over the next 20 years. Does that make sense?
Yeah, you just, that clarified it.
Okay. Alrighty, Drew. Let's see, what was next? Buy down loans.
Hey, so can you go back to that downline? I just wanna look at it. Thank you.
Okay. If you remember, a couple of weeks ago, we talked about how developers, in some cases, especially when we're dealing with like condo development and townhome development, that sort of thing, that a developer might offer below market financing to a particular, maybe the first handful of purchasers. In essence, by giving them that discount, they basically set the discount on the financing. They set the price point of the property higher than what it would ordinarily be. Okay. Now, what we didn't get into, which is what we're getting into now, is specifically how they can accomplish this through the use of buying down an interest rate from a lender. Okay? So, let us say that 12 payments per year and $500,000 loans. And the loans are for 30 years. And the market rate on the loan that a normal lender would be offering, let's say, is at 7%. Okay, so let's start off and just find out what our ordinary payment is going to be. Okay, without any funny business at all, our payment is going to be just a normal $3,326.51. Okay, so once again, that's normal market prevailing interest rate. So here's the deal that the lender or the developer is going to cut maybe with the lender. So the developer wants to buy down or, in essence, prepay interest for first 5 years of loan. Okay? Conceptually, does that make sense? So the developer wants to buy down or prepay interest for the first 5 years of the loan. Now, the question is, how much do they want to buy it down? You know, what do they really want to put on offer to a prospective purchaser? So if the normal rate equals, let's say 7%, which is what we've assumed for this particular market, this particular property type, but they want to buy it down at, let's say 4%. 4% for first 5 years. Okay, so here's the way you need to think about this. What does the lender want? Don't overcomplicate it.
Money.
They want their money. How much money do they want?
3,326.
Correct. They want their 7% return. Yes? Okay. So what the developer is basically doing is you're going to recalculate what the payment would be at the lower buy-down rate of 4%. Okay, so the difference between those two $939.43. Okay, everybody good with that? All right. So, in essence, you could just simply say, all right, the developer just cuts a check every month for the next 5 years or 60 months to the lender for this $939.43. Or the lender wants all the money up front to do this deal. And if that's the case, here's how we would sort of do it. Put that in as the payment for 60 months, or you could put 5 shift in, either way. And the lender just wants to maintain their 7% yield, okay, for that period. So the question is, how much would we have to give the lender up front if we were to do just a lump sum payment at the beginning of all of this to achieve this? $47,443 and let's say 9 cents. Okay, so that would be the dollar amount that the developer would basically cut a check for at the beginning of this 5 years if they wanted to buy down the interest rate for that period. All right, now, keep in mind, what is the motivation for the developer to do this?
Cash out $500,000.
To what, I'm sorry?
to cash out $500,000 to sell the unit for $500,000?
Well, to, in essence, hopefully inflate the overall price point of the actual property that they're delivering to the prospective purchasers. And one way they're able to do that is by lowering the initial monthly payments for those borrowers down by almost $1,000 a month, okay? Think of it like this. Also, there's another side effect to this. The other side effect, and I'm not saying it's a good side effect, I'm saying it's another side effect to this, is what are you qualifying the borrowers on?
Ability to pay.
Credit rate.
Well, their ability to pay, but specifically, if you lower their monthly payment by almost $1,000, you're qualifying them to, in essence, buy a more expensive property. Does that make sense? Yes or no? Okay, because yet again, most borrowers, they simply go to a lender and say, how much can I borrow? Okay, and then that dictates what kind of home shopping or whatever property purchasing that they choose to do. It's not based upon what they need as much as it is how much can they borrow. Okay, and that's the way that, unfortunately, in many cases, it tends to work. Okay, any questions?
Yeah. So when I started to push these buttons in, I have a completely different number. Wait, do you move on or do you make a zero line after that?
Yeah, once again, yeah, this would be a fresh problem.
Okay, so I did that and there comes like 158,000 or something.
Yep.
This number can just,
Well, you're not matching?
no.
Did you do 60 shift end?
Yeah, you probably did 60 shift in instead of 60 in.
I did.
This is only 60 months. So you could have put 5 shift in or 60 in.
Thank you.
Okay.
Also, is the assumption that they're sold out by 5 years?
It could be. That would be one way to potentially look at it, but in most instances, it's just to make enough of a difference so that the price point can be elevated for enough of a period of time to really take hold. And also, it's very possible that after 5 years, these people are going to have sold that property and they're not even going to be there after 5 years.
That's exactly what I was going to say. The developer has that 5-year plan,
Right.
and they'll be out of it, yeah.
Okay.
Well, the most common type is when they pay the full 47,443 rather than the payments a month of 939.
Right. Okay, moving forward. Going backwards to see where we are. What is next here? Oh, mortgage equity calculations.
You sound excited for that.
I am. All right. So basically, one of the things to help us to sometimes understand the valuation or to come at an evaluation, and we've done all of the steps involved in this mortgage equity value calculation, but we're basically going to have to combine a couple of steps from this and a couple of steps from this, okay? So, fundamentally, what this mortgage equity value sort of comes down to is, in essence, we're saying that the overall value of the property is equal to its mortgage value plus its equity contributions or equity value. Okay? That's nothing, that's just, once again, we're sort of saying overall value here. So it's, in essence, just simply saying debt plus equity equals overall value. Okay? Now, the question is sort of what we do to get there, okay? And what sort of information, excuse me, what sort of information that, in essence, that you're going to assume. So, let's start with net operating income. This is a little bit similar, but different than what we did last week. All right, so give me a dollar amount for our annual net operating income. And once again, it's commercial property.
500,000.
500,000. Okay, give me the debt service coverage ratio requirement for this particular lender. 1.3. All right, so what does that then mean our annual debt service would be?
384,638.
Okay. So if that's our annual debt service, what does that mean that our monthly debt service is going to be?
That number divided by 12.
So divided by 12, $32,051.28. So that's our monthly debt service. All right. What sort of an interest rate are we going to get from this lender?
It's 6%.
6%. Okay, so what we're going to do, this is going to become our payment. 6% is going to be our interest rate that someone gave me. Okay, what sort of a term? How many years for this loan? I heard 20, I heard 10, I'm going to split the difference, call it 15. So there, we're going to calculate the mortgage value. Okay, so what do we get?
3,798,189.
189.57. Oh, I guess I rounded off. Okay, that's fine. 32.33. If you just use the 28 cents and round it off.
Okay.
Okay, so that number, that represents, in this case, the mortgage value piece. Does that make sense to everybody? Yes or no?
Yeah.
All right. Now, let's say we can analyze this property or come up with a value for the entire 15 years. We could also truncate that and say we only want to maybe value this based upon the next 5 years and then sell it off after 5 years. So, or something else for that matter, okay, to come up with our equity piece of this. So let's say in this particular instance, so let's just kind of go back up here for a second. So we basically are saying $3,700,000 $98,189.33 is the mortgage value. So where are we going to get the equity value piece?
By dividing it by the LTV?
No. Good potential thought process, but no. What we're going to do is we're going to forecast, in essence, what our cash flows are going to be. Okay? And what our cash flows are going to be sort of over time, and then we're going to estimate what we're going to sell the property for, and then discount that back. Okay? So, if we simply took net operating income and subtract out annual debt service, okay, that leaves us with 115,380, excuse me, before tax cash flow each year. Okay, so let's just say that we use that as the income coming in off of the property. Okay, now let's also, let's see here. Okay, all right, so let's say we can do this a couple of ways. One payment per year. Oops. Do 0 as our initial cash flow. I'm doing this for a reason. 115, 384, 62, and that would be the annual cash flow, all right? This is a 15-year loan, correct? So let's just say we get that cash flow for 14 years. Then in the final year, we're going to have some sort of reversion value. I'm going to come back to that here in just a second. And then we're going to solve for net present value, and that is going to be our equity value. Okay? Now, how much do we think that we maybe can potentially sell this property for? Once again, this is 15 years into the future. All right? What might we do to come up with a resale value?
Take the NOI and divide it by the rate.
Thank you. So to get the resale or reversion, we're going to take basically the NOI divided by some sort of a cap rate. All right, so in this case, our NOI is staying constant at 500,000. All right, and say that we've got a cap rate of, I don't know, 8%, just pulling that out of the air. Okay, what does that give us? $6,300,000 $250,000. Okay, 500,000 divided by 8%. Okay, so we put that in. And then solve for NPV. Oh, well, sorry, left out one step. All right, so for the NPV, we would need to put in some sort of a discount rate for the equity value. So let's just say that we'll use the same rate as the cap rate. We'll just say 8%. So put in 8%. There we go. Okay, 5,564,128.95. All right, so we'll go back up here. 5,564,128.95. Add those two together. So the overall value would be 9,362,318.28, roughly. Okay, because of rounding. Okay, does that make sense? Okay, so all you're doing, just to make sure that we're clear, is you're calculating the value of the mortgage, then you're going and you're calculating what is the value of basically your cash flows that you're receiving on a before tax basis for the property over the holding period. In this case, the holding period would be the entire 15 years. Now, bless you. So, the thing to sort of keep in mind, part of what's going to be driving this value is going to be the cap rate that you use here, because that's going to dramatically influence what the reversion is, which is going to drive a good piece of the value associated with this. So if that cap rate were different, say it were something higher, like 10%, then that would lower, obviously, this down to basically 5 million, okay?
The
All right.
8 interest is the cap rate?
I'm sorry? What? I'm sorry?
The 8 interest?
Okay, one more time.
The 8 interest before net present value is the cap rate?
In this particular instance, I'm using the cap rate and the discount rate as being the same thing as 8%. Yes.
So that's going to be the discount rate, not the cap rate?
It's both in this particular circumstance. Okay? Okay, question?
Yeah, I'm not with those numbers.
It's not adding up.
Which one? Which part?
This last
The
part.
equity value.
NPV.
Okay, let's put it in one more time.
Yeah, 380.
Yeah, I keep getting somewhere around 2,642,000.
Yeah, 2,900,000.
Okay. I probably didn't clear it out. That's my fault. Let me just double check. 5, 384, 62.
Do you like combine the 6.2 and the 115 to put equal and then CFJ?
Yes.
Okay.
Yep, you're right. Yep, that's my bad.
I think I'm going crazy over here.
No, what I did was, right after I input this step, I then changed the interest rate, and I should have just went back and redid it.
Yeah, could you rewalk the steps through, please?
So the steps are the same. So the only thing that's gonna change is I should have, instead of basically continuing on here, I should have put the interest rate in.
So what's the final number?
2957, 892, 85 for the equity.
Added to the 3.7 million.
Okay. So the equity, 2,957,892.85. Okay. Added. Okay. So the total. I thought that looked a little bit high, but okay. All right, so the total overall value, 6,756,082.18, okay? So everything was correct except for this one piece because I failed to enter the number correctly.
I keep getting 5.5. I'm getting 5.5.
And this 8% that you added, that you forgot in the first place, what exactly?
This is your discount rate. It's just simply saying what sort of rate of return do you want as an investor on your equity.
So it's the net present value plus the mortgage value, right?
Well, in this case, yes, it is.
I'm getting the 5.5. I'm getting your original answer. I'm doing the same steps.
Okay.
Yeah, I got the same thing, but
Okay, I'm going to do it one more time just to make absolutely certain.
Could the cap rate and discount rate be different?
No. Well, yes, they can in practice, not here, they're not. Nope, this is correct. It's possible that, once again, make sure that you've got the equal entered here, and once again, you put in the 8%, but I double checked it, triple checked it, and it is 2957.
Yeah, it was the equal.
Yep.
can I ask a question regarding cap rates? So as the cap rate goes up, in my thought.
Cap rate goes up, value goes down.
Value goes down.
I mean, it's a very simple relationship because it simply means if the cap rate's going up, that means you're demanding a higher rate of return, which means the only way you can get a higher rate of return is to pay less. Thus the value going down. So it's an inverse relationship. As cap rates go up, values go down, and vice versa. Thus is why we have been in this continuous valuation increase for so many years now, is because interest rates have been ridiculously low, which correspondingly cap rates are low as well. Once all that begins to change, the whole world changes in the sense of values are going to be going down.
So theoretically, when you have a higher cap rate, could it also mean that the IRR that the investors are getting could also be lower?
Well, okay, it all depends. Okay. It's a question of whether you're holding income constant simultaneously. There are three variables in the equation. You've got your income, you've got your cap rate, and you've got your value.
Correct.
But if you're holding the cap rate constant, then whatever relationship that you've got basically between income and value it would just basically be going up or down proportionally because your cap rate's staying constant. But if your valuation is going down and your cap rate is going up, then it could be, once again, your income is staying constant. But now if your income is going up, that's going to have a positive influence on the value.
Which would mean that between your highs and your lows is what your true rate of return.
Yeah, to a certain extent, but I mean, the reality is the value is dependent upon income. And it's just a question of what sort of rate of return is acceptable to you at any given time, depending on what the market will bear. Because whenever I first started teaching, 32 years ago, the cap rates were pretty much almost universally 10%, okay? Now, most cap rates are probably half that, or close to half that, in some cases even lower than half that, depending on what the particular product type is. But that was driven by, back then, 30 years ago, interest rates were also substantially higher. A normal interest rate on a home mortgage was 8, 9, 10%. Now, home mortgage is what? 3, 4%. Okay? So, a value of a house back then at $100,000, that same house today, using basically very similar sort of metrics, would be worth twice the price. Just based on that alone. Okay? All right, moving forward. Okay. One of the things that we're going to deal with in a little bit more detail in the investments course deal with leases. But here, what we want to focus on is kind of what is the valuation of a lease, all right? And once again, talking about, typically a commercial property, whether it's an office building, shopping center, doesn't really matter. So let's say we've got a property. How many square feet is this property? Give me a
20,000.
20,000 square feet. Okay. So it's a nice little, let's say, strip center or office building. All right, 20,000 square feet. Now, let's say that whenever we acquired this property, that the leases that were in place at the time were $15 per square foot per year. Okay? So just to do the math,
300,000.
exactly. And that would be basically annual potential gross income. Yep. All right. Now, what if that basically these leases were in place for 5 years? But like I said, you've acquired this property, you're stuck with these leases for the next 5 years.
So these leases are for 5 more years.
Correct. And specifically, market rents have increased. They've increased substantially to where this was old rate, and then the new rate is maybe, let's just say, $25 per square foot per year. All right? Or a difference of
$200,000.
of old to new would be $10 per square foot per year, or
200,000.
sorry, 200,000 okay. Now, so this, in essence, you are, to a certain extent, losing out on, if you will, as the new owner of this property, the equivalent of about $200,000 a year based upon what the old rents were versus what current prevailing market rents are. Does that make sense? So you're losing out on $10 a square foot, okay, for 20,000 square feet of space. So basically $200,000 a year is what you're losing. Now, what are your options? Well, it totally depends on the tenants, totally depends on the leases, totally depends on, you know, what you maybe can do, but what could you possibly do? You can always reach out to the tenants and say, hey, you know, you're in this lease for another 5 years. Let's make a deal. Let's potentially make a deal of where you know that 5 years from now, I'm going to more than likely ratchet up your rent dramatically. Or we could ease into it and say, we want you to automatically renew now for an extra maybe 5 years. So we basically have 10 years remaining, and we sort of split the difference or something like that and sort of say, okay, instead of maybe raising your rent all the way to $25, maybe we split the difference and we raise it to $20 a square foot or something like that for the remainder of the lease term. Or, depending on the tenant, it could also be maybe you buy them out of the lease. You know, if you really think that it's worth, you know, potentially, and it's a question of how badly do they want to stay in the property. So that, you know, that might be another option, okay? My point, or at least the issue here, is how much are we really losing out on in terms of income, and how is that really kind of affecting our overall kind of value? Does that make sense? Okay, so specifically, let's say that we want to apply this sort of $200,000, I don't really want to call it a loss. I would just simply say it's a
income not generated.
Yeah, you can say that. Income not generated, that's fine. And what we want to do is maybe discount that by, I don't know, maybe a 7% discount rate. For 5 years. And what would then basically the present value of that be? Okay? So, kind of clean it up just a little bit. One payment per year. 200,000 as a payment. 7% as a discount rate. 5 years as a term, and then solve for what's the present value of that loss. Okay? So basically what we're saying is that the present value of that loss to us today would be $820,000. So another way of looking at this, in actual dollars, 200,000 times 5 years would be $1 million in lost revenue, but because we're discounting it at 7%, the actual net loss to us of income is equivalent to $820,000 in today's dollars. Okay? Does that make sense? All right. Any questions? Okay. All right, so we're about halfway through. So let's do this. We're going to take about a 5-minute break. And then we'll come back and pick up with
end of this valuation.
income approach.
Can you scroll up just a little bit, please?
So what does that mean, that we buy them out for 820,000 or something?
That is the amount that we're losing out on of income. So the question is, what do we do?
How much do we buy them out for?
We potentially, since that's the amount that we're losing, if we can find a tenant that would generate substantially more than that, it might make sense for us to buy them out. So the question is how much we could buy them out at.
But you're looking at every tenant.
Well, in this case, it might just be a single tenant, 20,000 square feet.
Yeah, right. And it doesn't take into consideration the amount of rent that could be increased in 5 years. So it's just today's present value.
Right.
Yeah.
Did somebody look at this thing that he sent, that Excel sheet that he sent?
The mortgage or?
Yeah.
And you just plug in the numbers.
Yeah, but can I show you something? I don't, somehow I cannot, even the beginning. Like, just this here.
So you just adjust that amount right to.
I will, like, kind of do the do equal, and then we do this here. Just want to do it again to get to the same thing. How do you get to this number? Do you equal?
That, I mean, should if you put, let's say, 1 million.
No, just go to the same number so that it comes the same thing out. Like, how do you get to this number?
Like how did
Yes.
you find it?
How do you
Yeah,
physically get to it? I don't physically get to this. Do this, I don't get to this. Like, do you put this thing in, this from
No,
financial
that's already
forecast?
inputted, so you just adjust long term.
No, I know that, but how does he find this number?
Oh, that's just the formula. You do PMT,
Yeah, try that.
and then you do.
Can you do that?
I mean, you'd have to move the cell. That's what I would.
Yeah, but it doesn't work. I did it.
Maybe I don't know if you have maybe.
And then, do you know how to get to this?
And I just changed it.
To this thing, to this here. To this payment thing.
What do you mean, how do you get to it?
Then you type this.
Because it's like it's. I don't know if she's trying to say the formula.
Equal,
for
then you get the
PMT.
formula.
Yeah, and then you, no, just hit PMT.
Otherwise,
formula's already there.
Say that again, show me on the,
Yeah. EMT.
oh, that's what.
Yeah, so those are gonna work.
And then you would have to put in what he puts in over here, right? So it's equal payment.
Yeah, but it's not working, that's what I'm trying to do. Even if you put this here, is it you go into this?
Like, you're not exactly getting the thing in red, or?
No, totally not.
There you go.
Yeah, but it doesn't give you the things.
What do you mean doesn't give it?
It doesn't give you the number. Rate, okay, 2,500.
But that's not the rate, that's the loan amount.
So rate you put in 5%. And it is the loan amount, right?
No, that's the number.
That's the
number of
years,
payments.
that's for 10.
Yeah, because if you look at his, so the first part is C5 is the rate divided by 12. So that's the annual rate, you need to get the
Okay,
monthly rate.
Okay.
And
Still,
then,
it does not have a consultant. I really want to know how he types the ring.
types it in just like that.
Look, we do like this, okay? I put this next to the same thing again. Then you go here equal,
And then just
you do
do,
PMT.
yeah. And then just do there. So then you want to do, instead of C5, it's going to be D5.
Yes, we do this,
And you want to divide that by 12.
12, comma, right?
And then you're going to do
The years,
the years times 12. Is this stuff. And then that. And then close your parentheses and hit enter.
And that's what they come to every time. So I don't know understand how to do this. Yeah, can I ask you a question? I've been playing with this Excel that you said. This number. Every time when I do this, I come to this number. Is it easy?
You put it in as 5, not 5%.
It's not funny. Okay. What is it? I think it is copy pasting out also.
What's that?
I think it is copy pasting out. Go like this. You have to keep this corner piece here.
Right.
And then you drag it down and that's it. Then you can have to do control.
Gotcha.
Okay, about 1 more minute and we'll get started.
Got too many distractions at home.
I think you can ask more questions.
All right, let's go ahead and pick back up. All right, so we've got 5 more little topics to get through, and then we'll switch over to Excel for a little bit, and then be done. All right, so one of the things that just briefly want to talk about, whenever a lender is looking at a property to potentially finance, they are obviously going to require some form of a market-based appraisal on the property. And those appraisals are different than the ones that you may be familiar with in terms of residential appraisals. These tend to be a lot more involved, but ultimately they come down to the same sort of stuff. You've got the 3 approaches to value. You have your income approach, you have your sales comparison approach, and you have your cost approach.
Hey, Matt.
And so with these 3 approaches, each one obviously, kind of has different sort of information that's kind of feeding into it. But what I want to do is to kind of go through a couple of relatively straightforward examples, but also fundamentally try to explain a little bit of logic and insight about these 3 approaches that you may not have really considered before. So the first approach that we're going to talk about is the income approach. And I would call it kind of the future looking sort of valuation. Because here, what you're doing is, in essence, you're saying, all right, what kind of income is a property going to throw off over the next however many years? What do you anticipate that the income is going to be, not only over the years that you own it, but ultimately, whenever you sell the property, what might you be able to get for it based upon usually, a cap rate and income. Now, like a lot of things, this approach is not without its flaws. In a sense, you're making a lot of assumptions about future income whenever you look at a property, all right? Even residential property, like, for example, apartment communities and that sort of thing, while they are, in many instances, probably among the more kind of easier to evaluate because you've got a lot of different properties out there to compare them to, and ultimately feel pretty comfortable with what the rent numbers are and that sort of thing. But yet, even with those, it's a whole thing looking into the future for whether it's 2 years, 5 years, 10 years, 15 years, trying to get a real honest handle on what the income is going to be for a property is a challenge, pure and simple. I mean, it's a lot like, if you really step back for a moment and you say about yourself, how many of you could honestly say that you could probably predict what your earnings or income would be 10 or 15 years from now? Okay? Or let's just sort of take 10 years back. Go back 10 years in time. How many of you think that you have gotten pretty close to where you are today in terms of predicting what your income is going to be? Some of you are going to say, right on, I got it, I, precisely, knew what I was going to be making, I worked for a company and we had a very simple, traditional kind of raises and expectations of what we're going to earn. And others of you would say, nowhere near. I'm making a lot more now than I was, or making less than I was. So my point with saying all of this, predicting income is every bit as much of an art as it is a science, in the sense of really, truly getting at these numbers. The problem is, and this is part of the lesson I guess I'm trying to convey with this, you as a developer, you as an investor, 99 times out of 100, you're trying to put a very positive spin on what it is that you're trying to invest in, what it is that you're trying to develop, what is it that you're trying to purchase, and so forth, so on. Sometimes too much so, okay? In the sense that you get, number one, emotionally attached to a deal, to where you may overpay or may potentially underrepresent what the expenses are and overrepresent what the income could be. This sounds all very common sense, and it is, but I will tell you over and over and over and over again, this is one of the biggest challenges, I think, that developers and investors face, is being able to detach from the properties they're evaluating and look at them with a cold, fresh set of eyes. This is one of the reasons why, for a lot of companies, you have investment committees, or you have lending committees, so that any one person is not necessarily going to drive the bus, or drive the train, or whatever it is, off of the cliff. That you hopefully, by having, 5, 10 different people looking at the deal unemotionally, and being able to sort of establish what they perceive to be the income the property may be expected to generate, the expenses, and so forth, and coming up with a valuation, that hopefully they're able to detach enough to where maybe make a very impartial sort of decision about that. Now, I'm saying all of that because, as I said, this approach is fraught with people overestimating, overinflating what the numbers are. Because, once again, one of the things we're going to be looking at in the investments course, when you're starting to construct operating statements for properties, you're going to inherently want to build in growth rates for rents. And you're going to want to say, every year we're going to get 2% or 3% increases in rental income. That, number one, may never happen. But even if you had flat growth, that could be hopefully a decent thing. But what happens, especially in this new environment that we're emerging, what happens if those rents start to decline? How much of an impact is that really going to be on the valuation of that property, okay? And so my point is, this approach, even though it's the approach that we probably rely on the heaviest, because it's, as I said, it's sort of forward-looking and future-looking, it's also fraught with some of the most problems. Now, from a practical standpoint, there's not a lot new that I'm giving you in terms of calculations, because at the end of the day, the income approach, it still boils down to our good friend Irv. It's still all about annual net operating income. It's still all about a cap rate. It's still all about evaluation. It's just a question of how deep of a dive do we go into that income number? How many assumptions are we making about that number of it being an accurate reflection of what the property's performance is actually going to be? Does that make sense? Okay? Thoughts, questions, observations?
Yeah, I have a comment. So everything that we've been doing in this class is really an offshoot of that equation.
It is. That's why I said pretty much the very first day. everything really boils down to this. You know, it's really those three variables, but we make them more complex. We collect more information. We sort of get at some of the finer points of where those numbers are sort of coming from and how they're being calculated and how they're being used, okay? But at the end of the day, it really still boils down to, all right, we've got an annual, you know, income of $100,000. We've got a cap rate of 10%, all right? And that means the valuation for that property is $1 million. It's as simple as that. Now if we all of a sudden we start changing the cap rate to, let's say, 5%, then that valuation doubles to $2 million. You know, but you know, it's just it's all about ultimately really those three variables and the interplay of those three variables coming up with whatever valuation that we come up with using the income approach, because all we're really doing to come up with a value is you only got two variables that you're really playing with. You're playing with an income number and you're playing with a rate of return or a cap rate number to come up with whatever that valuation is. And if you can feel good about the solidness and the security of the income number, in the sense of you've got leases that are in place for many years with high quality tenants, that alone should drive down your cap rate or your required rate of return, meaning you should end up with a higher value. Okay? Getting back to kind of what you were sort of talking about earlier. Okay? But what if that income is very unstable in the sense that you've got, putting it not so nicely, crappy tenants, okay, that basically have bad credit ratings and poor operating histories or limited operating histories or in vulnerable industries. And just because we're predicting we're going to get $100,000 a year of income doesn't make it so. Because if they all of a sudden stop paying because they're not able to pay, then we have to really then begin to sort of say, well, if that income is not stable, then we're going to probably want to demand a higher cap rate to compensate us for that risk that we're undertaking, which is going to then lower the value. Okay? Does that make sense, everybody? Hopefully, 7 weeks into this class, this makes sense. Okay? Hopefully, we've done enough calculations and kind of gone through this that this is becoming much more second nature. You're beginning to really think about this and think about, oh, okay, now it makes sense. And that's okay. That's the way it's supposed to be. All right? You don't necessarily pick it all up on the first day. All right. So are we good with that? Any questions?
So another comment. So in the future looking valuation, let's say for instance I was looking at a particular property and I was forecasting that income would be $100,000 for the next 5 years, and then COVID comes along and it kind of wipes it out. So what I've got to do is work backwards and say, okay, if I want to unload this property, I've got to adjust that R, the rate, at the sale.
Yes.
At the sale period in order to make up for that loss.
Yes. That's one way to look at it, absolutely. Because you're going to have to adjust the R, but because the income is basically being adjusted for you.
Correct.
Okay. All right. Anybody else? Anybody in Zoom land? Okay. All right. Moving forward.
So when we talk about the income approach and the sales comparison approach, we're talking about approach to valuation?
Yep.
Okay.
Okay.
That was one problem.
Yep. Okay, sales comparison approach. This is past value. historic value. Looking sort of in the rearview mirror, okay, of what has happened. So with the sales comparison approach, this is the approach that any of you that have been involved in the residential sales business, this is the approach that gets relied on the most heavily. Because what you're doing is you're looking at houses or townhomes or condos or whatever it might be and saying, okay, what have they been selling for the past 6 months or past year, okay? And at what price point have they been selling? But all of this is historical information. You know, just because a property sold for a certain value yesterday does not mean that tomorrow it is going to sell for the same exact price. It may go up, it may go down, depending on what conditions may have changed since that sale took place. Okay? So, entering into the environment that we're in, and this is one of the fascinating parts of this, is on the residential side of our business, usually the way things tend to happen is you have whatever sales have been taking place, and what have we been, you know, for the most part seeing? Values creeping up, yes? Getting to what I would say are unsustainable levels, okay? And part of it's driven by low interest rates, you know, part of it, you know, may be driven by not enough product, part of it may be driven by excess demand because of one area of the country or of a city or of a geographic region becoming more popular than what may have been the case previously, may be driven by tax policy. I mean, how many people have you heard of that have moved from high property tax states, high income tax states, to other parts of the country, you know? So there are a lot of different factors that can kind of come into play here, but just because you have all of these sales that have recently taken place, and you've come up with a value estimate for your property that you're trying to put a value on, doesn't mean that that value is going to hold forever, okay? And the farther that you look back in time, the less relevant those sales might be. So for example, once again, talking about residential, let's say that we're looking at townhomes, condos within a particular area, and there were a ton of sales that took place a year ago, and not a lot of sales within the past few months or a couple of months. You know, one would then begin to question, why? You know, why haven't we had those sales? Has it been because of COVID? Has it been because, you know, something else? There's not enough product. People aren't selling for whatever reason. You know, so are values still going up? Are values potentially going to be trending down? You know, those are all very relevant sort of questions to begin to ask. But the point is, with this approach, it's all historical information. You're not looking at what's happening really in the future. You're looking at what has happened. Okay? Does that make sense? Now, with this, especially as it relates to us, you know, this could be also not just looking at residential homes or townhomes or condos. It's hard sometimes to get sales comparable data for shopping centers, for office buildings, for industrial properties, because those properties, in most cases, number one, are pretty darn unique in and of themselves, and they don't trade maybe that often, you know, in terms of sell that often. But you may have, you know, once again, an office building or an industrial building that maybe, you know, nothing is sold in that market in the past 10, 15 years, okay? So, you know, finding even a comparable sale is not necessarily an easy thing to do, okay? So, and then even if you find something of a comparable sale that is a similar sort of property, once again, you know, if that sale took place a year, two, or so, is it even a relevant comparable anymore? Okay, and so, you know, there's some real issues there of finding appropriate sort of comparable sales. But one area on the commercial side of the business where this approach definitely gets used is obviously on land sales. Now, you may not have that many land sales that occur either, but yet, you know, this is where that you're going to look at the valuation of similar conditioned sort of properties in the sense of land with similar zoning, land with, you know, similar utilities available, land with similar traffic patterns. And if those, you know, once again, sales comparables don't exist, you know, you're not really going to be using them. But assuming that you do find, you know, land sales that occur, and let's say that you've got a couple of land sales and one sold for $100,000, and that was maybe 1 acre of land. You've got another one that sold for $150,000. Maybe that was 1.5 acres. One sold for $200,000. Obviously making the numbers come out very nicely here. Okay, but in essence, what we're really saying, okay, we've got these 3 different sales, 3 differently sized parcels, but in essence, we're saying that 1 acre of land is going to sell for roughly $100,000. So if we've got a parcel that's 3 acres, then it would make reasonable sort of assumption that it would sell for what? 300,000. Okay? Does that make sense? Now I'm oversimplifying it, but yet the concept is there of where we would simply want to identify multiple properties, what they sold for on a per square foot basis or on a per acre basis, and then ultimately, then from a valuation perspective, all you're doing is just simply saying that maybe, you know, another thing that you might even include is this one sold 6 months ago, this was a year, this was 8 months. Okay, and in this particular case, the valuations are all the same on a per acre basis, so there's no real variability. So you know, would probably feel fairly comfortable that the value is still $100,000 an acre. Okay, make sense? Okay, moving on. The cost approach. So the cost approach, to a certain extent, is the current value. Based on current cost. Okay.
This would not be related to the CMA when working on the realtor, right?
It's similar, but this is the cost approach here. What we're dealing with is typically we'll start off with land value and then add on construction cost and then subtract away any sort of physical deterioration, functional obsolescence, and economic obsolescence associated with the property to come up with the valuation. So from that standpoint, yeah, when you're doing like a competitive market analysis, if you're including sort of construction cost and land cost, then that would be an example of using the cost approach. But the cost approach is really fundamentally, it's construction cost plus land cost minus physical deterioration, functional obsolescence, economic conditions or economic deterioration to come up with a value. And here, this approach is also going to be used most heavily by, in a lot of cases, non-income producing properties, okay? You can still use it on income producing properties, you can still use it on residential properties, you can use it on any, but where this approach tends to be more heavily used is whenever you're dealing a lot of times with public sector sorts of things, like trying to value a city hall, trying to value a parking garage, trying to value a library, trying to value a church, trying to value, you know, a cemetery or whatever, okay? But fundamentally, all you're really doing is you're saying, okay, what would be the cost to acquire the land? We're saying, okay, $100,000 for the land cost. And then to build as if brand new on the property, $400,000. And then if the property is a brand new property, you're not going to have any physical deterioration. You're not going to have any functional obsolescence. You're not going to have anything economically that's going to be inherently destroying the value of the property. So there, your valuation would be $500,000. But if we have an older property, we're going to try to estimate what the cost of construction would be to basically replace or replicate what is there. You're still going to have your land cost, but what you might find is that you've got $25,000 worth of physical deterioration on the property that has occurred over the past couple of years by virtue of style changes and kind of certain features of a property no longer being in kind of a traditional use.
Well, today with COVID, offices will change.
You're gonna have modifications to kind of how things might be organized or set up or arranged or distanced or whatever. So you may knock off some value basically to make those modifications. And then other economic conditions that may be present that you knock off some value there.
And these are all subjective numbers.
Yeah, potentially you may try to base them on, you know, some sort of like to fix them. You know, here's what it would cost to fix the physical deterioration. And then the functional is, it's something that you maybe no longer need that's present that you may have to remove. It may be something that is not there that you need to add. But it's something that has to do with the overall functionality of the property to make it useful and viable. And then the economic piece is more kind of outside market conditions that have sort of evolved or changed in some way that could impact the overall performance of the property. All right? Now, assume that we've got all of this, then let's make sure I don't screw up the math.
$395.
I would trust you, but I don't want to trust anybody. All right. So 500 minus 25,000 minus 30,000 minus 50,000. I get 395,000, is that what you said?
Yes, sir.
Okay, good. So $395,000 would be sort of our adjusted value using the cost approach, but adjusting for basically a diminution in value based on the physical deterioration, functional obsolescence, and economic conditions. Okay? Does that make sense? Okay? Now, my point is, yes, you can apply this to any sort of property type. It's just what most of the time we focus on in the cost approach is what's our land cost and what's our construction cost. The part that, as you were sort of saying, can get very subjective very quickly is what sort of adjustments that we make for the physical deterioration, because, I mean, we're talking about a commercial property. You know, one person says, I don't see anything wrong with it. Somebody else says, you know what, I think it needs new carpet. I think it needs, you know, a fresh coat of paint. I think it needs an upgrade and something else.
Maybe
Yeah. So the point being is, you know, those can be a bit more subjective, but nonetheless, you know, you just simply want to make sure that, you know, as a potential investor in the property, that you are accurately accounting for these things. A great example of the physical deterioration doesn't need a new roof, you know, and that could be a huge cost that, you know, you've got a roof that maybe was meant to be a 20-year roof or whatever, and you're 15 plus years into that roof, so you know that probably within the next 5 or so years you're going to have to replace it. That would be an adjustment that you would want to make off of the overall value of the property. Okay, does that make sense? Okay, moving forward. Almost there. Sale leasebacks. All right, this is has been a very common development strategy of a lot of big box tenants, okay? And what I mean by this, probably the CVS, Walgreens were probably the absolute dominant player for many years with this approach to buying, developing, and then selling off and then leasing back the properties that they occupy, okay? And you're saying, huh, what? Okay, here's the way it would work.
Is it Walgreens?
I'm sorry?
Is it Walgreens?
Yeah, something like Walgreens, CVS, like I said, sort of like a big box-ish sort of tenant. All right, so they go in to a market, they find a property that's for sale, and they find the property that they want, that they think, you know, has good market conditions. You know, it's got a great location, you know, great sort of visibility, great sort of traffic counts, you know, easily accessible, you know, from those road systems. And they come in and they say, okay, we're going to take that parcel and we're going to build our box on it. All right? And so they build their box, and let's say that their land cost, just to keep things simple, $1 million for land. All right? Then let's say that the building that they put on it with all the site work in terms of a parking lot and everything else they've got to do, let's just say that's another $5 million. And I'm just making these numbers up. Okay. So land and building, all in, $6 million. Okay? So that's their total sort of development cost. All right? Well, then they say, you know what? Is it such a great idea for us, CVS, Walgreens, whatever, to own all of this real estate? Because this represents a lot of cash that we would have tied up in all the actual land and the facilities. Is there not a development play for us to make? That would be the question they would be asking, okay? And the development play is they know what they're doing in terms of the site selection. They know what they're doing when they've built the buildings. They've built hundreds of them, if not thousands or more, okay? And so they know what they're doing. They find the right sites, they build the building to their specifications, but then they say, you know what? There are investors that are out there in the market that would gladly take this off our hands, pay us cash money, and then we lease that property back from them, okay? Well, the play is if they can then sell the property to an investor or groups of investors for, let's say, $7.5 million. So a gain of, let's say, $1.5 million. They're selling it for $7.5 million. So in other words, their profit, $1.5 million. Okay, does everybody follow me? Yes or no? All right. So their development play is, sell it for $7.5 million. They pocket $1.5 million, and then they engage in a long-term lease with someone based upon this valuation of $7.5 million. Does that make sense conceptually? Yes or no? Okay. So the lease that they might engage in, let's just say that we take this $7.5 million and we make that basically present value here for a moment. And we make it a 25-year lease. And we give the purchasers a fixed return equivalent to 5%. What would that mean? In essence, the lease payment would be.
I've heard of it. $32,142.42, $43.42.
Okay, so the monthly amount would be $43,844.25 multiplied by 12. The $526,131.04, let's say. Okay?
Okay. I still have the one payment a year in there.
Yeah, why didn't you use one payment a year to start?
It'll be a little bit different.
Yeah.
Okay, now, let's think about this for a second. Just eyeballing this. If we've got to make, if Walgreens has to make lease payments to the owner of the property for $526,000 a year, roughly, what's one way we can look at this?
What was the
Just
question?
use some common sense.
What was the question?
Look at this from the perspective of Walgreens for a second. What would you be saying from their perspective about this deal?
They have to make 526 payment per year to the owner of the property.
Yes, But that's what I'm asking.
So that means in 3 years they are losing all the profit.
Okay, I wouldn't put it that way, but that is one way to put it. In other words, they're able, for all intents and purposes, to occupy this property for 3 years.
Basically for free.
For free.
Right.
Do you follow? So from an operational perspective, that allows them more than enough time to get, up and running, to get all the kinks worked out, whatever, and still pocket some cash. Because they're still earning enough money to pay the lease payment. That's not the issue. My point is, this further reduces the risk for Walgreens or CVS or whoever, because they've got $1.5 million sitting in the bank, and in essence, that means that they can, as I said, go for 3 full years without really having to worry about making a lease payment. Or, another way to look at it is they could really, just set aside that money as just long term and lower their overall operating costs. They could spread out the $1.5 million over the full 25 years if they wanted to, and then lower their effective cost of occupancy over that time period. Does that make sense? There's a lot of different ways they could do it, is my point, okay, and how they treat it. The important piece of this is to, number one, understand kind of their motivations for doing it. They're in the drugstore business. They're not in the real estate business, okay? Yes, this is a real estate play, but it's not their primary business. So for them, this is just a nice, simple business model to give them flexibility in terms of not having to take on mountains and mountains and mountains of debt. All they really have to do is to commit to these leases for this period of time. Does that make sense? Yes, no, possibly could be. Okay?
Yeah, I have a comment.
Yep.
My uncle's been developing Walgreens for 30 plus years, but the 2004 one he built just sold last year. And I was like, wow, that went a long time. But the Walgreens Corporation was still involved that long later, rather than way past the 3 year mark.
Yeah, no, absolutely. No, the point being is, yes, Walgreens is still making those lease payments for the entire 25 years. Okay? It's not like Walgreens is removing themselves from the deal after 3 years. I'm just simply saying, in terms of cashing in on their profits, they're able to do so basically within that relatively early time horizon. The other piece to this that's interesting is the kind of leases that would be engaged in here.
I was actually going to ask you about that, if it would normally be like a triple net.
It is typically referred to as an absolute triple net. And the reason it's called an absolute triple net is because basically Walgreens or CVS, whoever is the actual tenant, is responsible for everything. Okay? So you, as the owner, the one that's getting the lease payments, each year, you're paying for nothing. Because Walgreens is going to pay for the property taxes, they're going to pay for the insurance, they're going to pay for any and all building maintenance, building repairs, everything. You are the epitome of the absentee landlord, in this kind of a situation as the owner of this property. You are getting mailbox money, okay? You just go every month to your mailbox, you collect the check, you cash it. That's all the work you do, okay? And it works, and the sort of folks that tend to invest in this, higher net worth individuals that, potentially can, have a couple of these sitting, and it's a great retirement scheme. They front the cash, and then for the next 25 years, They're just getting checks in the mail. And then at the end of 25 years, then there may be the ploy to have it redeveloped, tear down the building, build a new one, or sell it off to somebody else, or whatever might be the case. In many cases, probably get the lease renewed.
So can we calculate the yield that he makes the owner of the?
Well, the owners is going to get 5%.
5%.
Huh.
That's it. They're not, I mean, because they're not doing anything.
Okay, so the.
Yeah, it literally, it's just mailbox money.
Yeah, if they had expenses, it would be different.
Yeah, but they're doing nothing. They're just giving cash. They're writing a check. All the investor is doing, they're writing one check for $7.5 million. And then for the next 25 years, they're going to their mailbox and they're getting $43,844 a month in mailbox money. That's all they do. Okay? Make sense? Questions?
So then, so Walgreens is making 3.5 right off the bat.
Yes.
Right? That's their profit.
Yes.
In this investment scenario, a lot of Walgreens do this, but I noticed lately, like the big box corner stores, I don't know, for whatever reason, online shopping or whatever reason, a lot of these end up empty.
Mm.
They're just sitting there empty. Walgreens have moved out or CVS have moved out.
Yeah, and in a lot of
So
cases, it may be the case that, once again, their leases are up. And they just decide to move on, or not, that market maybe is oversaturated.
Yeah, and then what happens to that investor or that mailbox money?
Too bad. I mean, but that's, once again, after 25 years. So you've made back your money.
Yeah, you made
13.153.
And you still own the land.
And you still own the property.
But no, some of the CVSs are brand new. Like CVS is not a 25-year company. Some are like only 4 or 5 years, brand new built, and they're empty now. So what happened if you didn't?
Well, if that's the case, then you clearly made a bad investment as the investor. In a neighborhood or a situation of where it wasn't long-term viable. But depending on the arrangement that you may or may not have had with CVS or Walgreens, that there may be, in terms of their escape clause, it could very well be that they can escape if sales don't achieve a certain level. I mean, there are all sorts of side deals that can be cut. All I'm trying to describe is, here is one way this is set up. Okay? I'm not going to say it's going to work in every single instance, because it totally doesn't. But in terms of the structure, it's something like this. Yep.
A question. In those particular instances, I know exactly what he's talking about, where you see these Walgreens on the corners where they have opened up that particular community. But the investor really hasn't lost, because he's tied into some type of agreement where he's guaranteed he's going to get a certain amount of cash flow for a particular time. It's just that Walgreens may decide their business model.
That's what I'm saying. That every one of those deals is going to be different. Just like you have with grocery stores, that you can have a grocery store chain that picks up and moves. They still have 15 years remaining on their lease, but they may have to pay out for the next 15 years. But it can also be the case of, depending on the arrangement that they had, if they didn't achieve a certain and maintain a certain level of sales, they had an escape clause that would allow them to basically remove themselves from the situation. So that's a whole additional layer, I guess is what I'm saying, on top of the base deal. But the base deal is the base deal, which is pretty much, you build it as Walgreens, you ultimately sell it to somebody, and then you lease it back from them.
And then you have to be a pretty savvy investor to do these type of deals.
Well, you have to be aware enough whether or not this is a market or a location that hopefully would have long-term viability. And also, depending on, once again, what agreement that you're able to engage in with, like a Walgreens or CVS. I'm just using them as an example. They're not the only ones that do this. So it ultimately just gets down to, this is a mechanism for them to avoid a lot of debt and offer up a product that there's an awful lot of people out there that are willing to latch a hold of. Okay? All right.
Hey, sir, you did say after you sell it, you lease it back out.
Correct.
Can you explain that? Because I kind of got lost there. So you sell, because I'm looking at it, it was what, 6 mil, you sold it for 7.5.
Correct. And then you lease it back for $43,000 a month.
So in essence, you recover your construction costs and the cost of the project, but then you pay the person that gives you the cash monthly.
Yeah. I honestly thought you were like refinancing at this point. Because
No.
sold it.
No, okay. Once again, let's make sure that it's very clear. All right, I am Walgreens. I go out, I buy a piece of land for $1 million. I build a building for $5 million. I have a $6 million investment. I say, I don't want to own $6 million worth of real estate, especially if I'm going to be doing this hundreds, if not thousands of times. Okay? So therefore, I want to sell this to some wealthy person that has $7.5 million worth of cash laying around. They write me a check for $7.5 million. They agree to a 25-year lease with a 5% rate of return on that $7.5 million each year. Then I, as Walgreens, write them a check every month for $43,000 or the equivalent of $526,000 a year for the next 25 years. Okay? All I'm doing is I'm switching, as Walgreens, from being the owner of the property to being basically the tenant of the property and only having the obligation of making lease payments, not having to have all this additional debt hanging out over my head. Does that make sense? Okay?
Yeah.
Okay.
That was a big vehicle for pension funds at one time.
Absolutely. I mean, I personally knew a bunch of people in Dallas, Texas that, I mean, they couldn't get enough of these things.
Yeah.
I mean, it was a
That's
huge,
what
huge.
those used to do with their capital. They had a capital markets department with all their profits.
Okay, so our last little sort of lecture topic is called partitioning the internal rate of return. Okay, by now, hopefully you understand there are two different ways you make money off of owning real estate. What are those two ways? Selling it is one, and operating it. In other words, you have either operating income or you have basically the money that you get from selling the property, okay? One of the problems that you encounter as an investor, as a developer, is trying to understand how much reliance that you are, or faith, maybe another word, how much faith that you're placing in the operating income from the property versus how much faith that you're placing in the long-term resale value of the property, okay? And trying to get a handle on where the actual return is coming from off of a deal. And if you think about the word partitioning, what does that word mean to you? Ignore the IRR piece. What does the word partitioning mean?
It's going to be dividing.
Dividing, okay? Separating, okay? Segmenting. So all we're wanting to do here is to basically look at the cash flows associated with a project, and then in essence saying how much of that cash flow is coming from the operating aspect of owning it versus how much are we really placing or emphasizing or relying on in terms of resale value. Because here's what can happen. And it's not that there's an absolute right or an absolute wrong. It's trying to understand what is actually happening is what we're trying to do here and understand here. For example, one extreme would be I buy something, it generates no income whatsoever, no expenses, and then I sell it at some future date, make a bunch of money off of it. Okay, there, 100% of the internal rate of return is going to be generated by the sale. Okay? Another sort of extreme would be I buy a property and I use it and I abuse it for years, not really put any money into it, and just completely destroy and devastate the long-term value of the property, that at the end of, whatever the holding period is, let's say 10 years, the building or the improvements are worth nothing. Okay? It may have some land residual value, but there, what you would see is the overwhelming majority of the IRR is really going to be based on the operating side of the real estate. Does that make sense? Now, theoretically, and I use that word, I think appropriately here, theoretically, you want to see some sort of a balance between the two. That one is not necessarily super skewed one direction or the other, because if it's super skewed toward the residual value, then what are the risks that are inherent within that? That if you've got a 5-year, 10-year hold on this thing, a lot of stuff can happen, and you basically haven't generated any income during that period, and you're basically banking or betting on the value 5 or 10 years from now, because you're not getting anything in the interim. Versus the other approach, which is, as I said, kind of milking the property, in the sense of every dollar you could get out of it for the next 5 or 10 years, you get the money in the bank, but you've destroyed the longer term value, and that is why many owners of real estate tend to be those kind of owners of almost, hey, we just want to, get every dollar we possibly can right here, right now, lock down those dollars, and we don't really care so much about the future. But the more reasonable, rational, longer term, sort of players are usually going to be a bit more balanced and sort of say, hey, we want some operating cash flows, so we get some money now, but we also are willing to wait a few years, potentially, and we want the value of the property to still be there at the end of 5 years, 10 years, whatever it might be, from a resale perspective. Does that make sense conceptually? So what we're doing now is just trying to see what percentage of the internal rate of return or the present value is coming from one versus the other. So here would be an example. So $100,000 maybe is what we bought the property for. And then each year, let's say that we get $20,000 of income. And at the end of 5 years, let's say that we're able to sell it for $125,000. Okay? All right, so what we're going to do first is just treat this like we would any other sort of cash flow problem. But, okay, let's go ahead. We'll put it in both ways, because I want to illustrate something real quick. All right, so one payment per year. This goes in as a negative cash flow. And then, oops. Yeah. These all go in as cash flows. But since they're all the same, we could actually shortcut the process and just put in present value, future value payments, but okay. We got all that in, and then we start off and we solve for internal rate of return. So let's start with that. Okay, so I get 23.157% as the overall, just normal internal rate of return. We've done nothing strange or weird yet. Okay? Waiting to make sure you're matching that. Okay, everybody matching?
No.
Oh, thank you.
For
Okay,
some
what
reason I'm getting 24.7, and I did it exact.
Okay, anybody else? Anybody else got something different? Okay, is the begin in your display, Jim?
What was that?
Is begin in your display?
Is what in my display?
B-E-G-I-N, begin.
No, we had to change it to begin.
No, I'm just saying if you did, that might be one reason it would be off.
No.
I would say put it in again, because it sounds like that.
I found the same.
Okay. Everybody else is matching up.
Jim, do you have the one payment per year?
Yes.
Okay. All right, so once we've got this, we could, because all the cash flows are the same, we could have put in 100,000 present value, 20,000 as payment, 100, 25,000 as future value, 5 years as the term, and then solve for the rate of return, and you should get the exact same answer.
And that's only when the cash flows are the same.
That's only because the cash flows here are the same. Okay? But it just shortcuts the process a little bit. Okay? Now, okay, we haven't done anything new yet. Okay, that's just we've done internal rates of return a million times. Okay, now, the new piece, and we can do this a couple of ways. If we want to kind of continue on here with what we have in terms of the cash flows, we could sort of, let's clear everything out here for a second. And let's say, okay, we want to look at this investment. It's a 5-year investment. We're getting a 23.157% rate of return. So that's our interest rate. Okay. And, whoa, what just happened? Okay. Not sure what just happened there. That was weird. That was very weird. Okay. All right. So we kind of go back and we say, okay, we have this investment, 5-year term, 23% interest rate or rate of return on it. Then we take just the future value piece, $125,000. Put that in as our future value. Then solve for present value. And it should get 44,117.87. Yes?
Yes.
Yep.
Okay. Now, I'm slow walking this on purpose.
Why does it say minus?
Well, just because one has to be a negative to be a positive. So they have to balance each other out. Just a question of which one you choose to make a negative or make a positive. Okay, so we basically do the same thing. But this time, we simply put in the 20,000 as the payment amount, and then solve for present value. Okay. Here we get 55,884.36. Okay? Now, I want you to add these two numbers together. You're probably going to be off a little bit, but somewhere, it should be, the simple answer is, it should be basically $100,000. That was what we originally invested, okay? Does everybody see that? So, in other words, one way of looking at this, and I purposely made it $100,000 so the math was easy. So in essence, what we're saying is 44% comes from what?
Comes from
the present value of the sale. Okay? The other 55% of the IRR is the present value of the operating income.
Oh, yeah.
Okay? Does that make sense to everybody? Yes or no?
Yeah.
Okay? So all you're doing, that's what's called partitioning the IRR, is that we're saying the overall rate of return for everything is 23.157%, but what we're saying is, of that internal rate of return, the overall percentages attributed to the resale of the property versus the operating income, that this is fairly balanced, I guess is what I'm trying to say. In other words, you're in essence saying that 44% of the return you're getting off this property is coming off of the sale of the property, whereas the other 55% is coming off of owning the property. Okay? Now we could skew those numbers if we were to do what? If we were to inflate the future value, you know, and sell it for $200,000, well, that's going to then drive its percentage up significantly. And you're saying, well, what's the relevance of this? What is the purpose of this? The underlying purpose of it is, if these two numbers, or two percentages, are probably off by more than plus or minus 10 to 15% of each other, then you're probably saying it's skewed one direction or the other a bit too much. Does that make sense? And that you want to at least take another look at it, okay? Not saying that that's an absolute, but it's the sort of thing that, for example, if this ended up, instead of being basically 45-55, and it was more like 30%, 70%, we would sort of say, wow, that's a lot to really be attributing to the operating income, and the long-term value, for some reason, is not really being captured. Or, flipping around the other way. What if this was 70%, this was 30%? Then that's where, as I said, we're probably placing a little bit, maybe too much emphasis on the resale of the property. So all this really is, in my opinion, is just kind of a gut check of just, whenever you calculate this, you would then be able to kind of say, all right, does this appear to be balanced or reasonably proportionate? That if it's way out of whack, you've got to be questioning what maybe is going on there. And are you really, is that what you want? Because it may be that's what you want. You know, it may be that you're just simply saying, you know, we want to bank everything on the future value of the property and not so much off the operating income. But if that's not what your strategy is, then you maybe have to rethink it. That's all we're really saying with this. Okay? Questions from the gallery?
Are we saying that, like, in a healthy circumstance, that basically the property is we're gonna have 50-50?
Well,
like
that's what I'm saying. 50-50 might be a bit extreme. That's why I sort of said like plus or minus 10 to 15% of each other. Okay? And there's no hard science to that. It's just more of like.
Translate it to which language?
Whoa. That is kind of an interesting new feature. I don't know whether you've upgraded on the whole thing with, I guess, the latest operating system, but now all the language translation stuff. Have you guys seen that on it? And it's really kind of, it's wow, cool. Anyway, but no, the point being is not that there's any hard science about it being, you know, plus or minus, you know, 10 or 15% from one to the other. It's more of, whenever you do the calculations and you see it's really out of whack, one would hope one of the questions you would ask would be, why is it out of whack? What is it that's going on here that maybe we just need to take another look at this, is all I'm saying. Okay? It's just one metric of many to sometimes just, whenever you're doing sort of a sniff test of a deal, that you might say, well, why is this radically skewed in one direction or the other? Okay? Yep.
Oh, you did the calculation up here for the IR. Is that just a check at the top when you were?
Yeah. Well, you sort of have to do it in order to have it over here, though.
Okay. Because I was just trying to think if there was different cash flow values.
Yeah, I mean, we could get more deeper into the kind of philosophical nature of this in the sense of saying that maybe we want to apply a different discount rate to operating cash flows and a different discount rate that we want to apply to basically reversion. And that's perfectly acceptable as well. It's just, what are our reasons and rationales for doing this? This, we're just simply saying, we're using the overall return for the overall deal and then splitting it or partitioning it apart based on operating income versus resale price. Okay? All righty, Ruth. So that gets us through the quiz stuff. Now, open up the spreadsheet that I sent you this week via email. Let's see here. Go back to, should be able to see everybody. There we go. All right. Let's do the share screen. Zoom. There we go. Okay. Is it showing up on y'all's screen at home? Zoom land? Okay, good. All right, so this is a spreadsheet that I sent to you guys via email, I think yesterday or so. This is another variation of kind of the one that I briefly showed you in class. This one's a little bit more streamlined, but it accomplishes everything that we really basically want to accomplish. So, to kind of, all I'm going to do is, once again, you're not responsible for this for the quiz, so you don't have to get yourself all worked up and excited about that, okay? This is more of me just simply kind of walking you through a couple of interesting little functions within Excel that if you want to take advantage of and you want to be aware of and be knowledgeable of and be able to use, then pay attention and we'll get through it. Okay, so with this model, you obviously have the baseline sort of information for an amortization schedule here with the loan amount, interest rate, and term, and then the first calculation is just the monthly payment that it calculates for you, which obviously we talked about previously, which is nothing more than taking into account obviously those variables to come up with what the payment amount is. But you can obviously play around with it on your own and kind of experiment with it. All right, then we go down and we got some more input variables, specifically loan origination fees, monthly servicing fees, prepayment penalty fees, and then if the loan is prepaid, what month it's prepaid. But the calculation, the big calculation that we have focused a lot of our attention on in this course has been sort of the lender's yield, and that's what this particular value is giving us. So what I'm going to do is just kind of walk through where some of the different formulas and a couple of things and try to answer questions as we sort of go along. So the logical place for me to start is over here at the lender's cash flow, okay? So I'm just going to kind of scroll up here just a little bit. All right, so the lender's cash flow column is basically where the repository of sort of income and expenses associated from the lender's perspective, where all that stuff is being dumped, okay? So that we can use this column to do our calculations. And it's basically cash flows. All right? So the very first cash flow for time period 0 is how much are they actually dispersing? Okay? Well, in this case, it's just taking the original loan amount and then subtracting out, in this case, 2% for loan origination fees. Okay? And so the formula just reflects that. So if you actually go up to the loan origination fee or discount fees, and you were to put a 0 in there, what you should see, now the lender cash flow shows up as $100,000. Okay? Obviously, no discount fees, then nothing's being taken out there. Okay? All right? Does everybody follow that? Yes?
Can I stop you for a second? So up at the top, that is considered our year 0.
Yes.
Okay.
Okay? All right, so I'm going to put the 2% back in there. Now, you can obviously put any percent you choose, and it will obviously make the adjustment. All right. Now, the administrative or servicing fees, in this case, $50. Okay? Here, all you're doing, if you look at the cash flow, oops, yeah, come on here. Why is it? All right, for whatever reason, screwed over. Okay. Now, this is where it starts to get a little bit more involved, okay, in terms of what it's actually doing. All right, so try to see if I can scoot over a little bit. Okay. This is where we begin to use if-then statements, okay? And if you remember, last week I briefly mentioned this, and I said, okay, an if-then statement allows you to perform logical operations, okay? So in this case, let's just sort of read through this. This is probably the best way to understand how an if-then statement works, is just to kind of read through what is basically being asked and what's being done. Okay, so we start off, every if-then statement, you just simply equal if, and then you open basically the parentheses, and then you take a look here and it says D11, okay? So what is D11? D11 is the prepayment month. In other words, that is the month that prepayment occurs, okay? It's cell D11, all right? So let's continue. It says if cell D11, which is the prepayment month, if that equals cell A17, which over here is, in this case, it's going to be, fortunately, I'm going to have to kind of scroll over. It's the period number, okay? So, if D11, 36, equals 1, then you're going to do the following. You're going to take and you're going to add C17, which is, in this case, the monthly payment, and you're going to add it to, cell D9, which is the monthly fee, and you're going to add it to F17, which is the ending balance, times, oops, that, okay, you're going to add it to the ending balance, which is F17 times basically 1 plus the what? Prepayment penalty. Okay? Now, that is if that is the month it is prepaid. You're going to do all of that. If it is not the month of the prepay, Then all you're going to do is add C17 plus D9, which C17 is simply your monthly payment plus D9 is your monthly servicing fee. So in other words, you've got two choices. With this if-then statement, it's either going to be the prepayment month or it's not going to be the prepayment month. If it is the prepayment month, you do all those calculations. If it's not the prepayment month, you only add the monthly servicing fee and the actual payment for that month together. Does that make sense conceptually? So what happens, and all that, then you can just pretty much copy all the way down. But let's scroll forward, in this case, to actual month 36, where the prepayment does occur. Okay? Now, when you click on this, it's the same formula, pretty much as what was above, but what has happened is now, if you look at cell D11, which was the month of prepayment, which was 36, yes?
Yes.
That matches now with the month 36 here. Therefore, you're telling Excel, woo, they match. Now, we do all of those calculations that we just talked about in terms of adding in the prepayment penalty, adding it to the payment, adding it to the administrative fee, and so everything gets included in that one cell. Does that make sense? Yes or no? Okay, so what happens is because of that if-then statement, let's just take a look up here at the top. All right. What would happen if I changed this cell from 36 to, let's say, 5?
The prepayment penalty go on period 5.
Boom. Month 5 now is the month that everything gets prepaid and the penalty gets assessed and so forth. Does that make sense? Yes or no? Okay. Now, the next piece of this is the column, the effective cost of borrowing. Now, I'm going to say this, I want to make sure you're paying attention. The only number in this column that is accurate and makes any sense is the one associated with the month of prepayment. In other words, month 1, 2, 3, 4, and 5, I'm sorry, 4, those numbers are irrelevant. They're crazy numbers, okay? Ignore them. Pretty much ignore everything then from month 6 all the way down. Those are also crazy numbers. They don't make any sense. The only number that's going to make any sense is the one associated with the month of prepayment. Okay, does that make sense? Because if you look at the formula for that column, it's basically just the internal rate of return for that particular set of numbers. Does that make sense? Now, the question that you should have is, okay, that's wonderful, but how does Excel know to go and get this specific number? And that's where you use the index function. Okay? And so if you look at what the index function has, basically you've got I-17, which is right here, through I-376. So if you go all the way down the page, that whole column is what we are going to call an array. It's just a block of numbers that in and of themselves is sort of meaningless, except that's where think of it as a database that we're pulling from. Okay? But what we're telling it to do is to pull D11, which is basically whatever the value is for the month of prepayment. So in other words, by saying the index is D11 and it's 5, then what this function in Excel is doing is it's saying, go 1, 2, 3, 4, 5. That's the one we want. That's the number that we pull back and we put into the cell there. Does that make sense? So in other words, if you change this to, let's say, month 9, okay? Now, what it's doing in the index value is it's saying, okay, this prepaid at the end of month 9, so in this array, we're going 1, 2, 3, 4, 5, 6, 7, 8, 9. That's the one we're pulling. Does that make sense, everybody? So it's a really cool function because then it allows you to, in this case, pull the relevant number so that you don't have to scroll down potentially pages and pages and pages. Like, so as an example, if I were to put up here month 180, okay? Instead of me having to scroll down to month 180, we just know that it's pulling month number 180 and giving us whatever value is in month 180 up here for our effective cost of borrowing, which is nothing more than an internal rate of return calculation. Okay, does that make sense, everybody? Yes? Now, the only other little thing that's in here is on the interest rate column that I embedded here. The way that I set this up is whatever the normal interest rate is. Let's just kind of go back up here for a second. Whatever the normal interest rate is, so if you change that to 5%, then it changes everything down here, all of these to 5%. Okay? Now, all it's doing is, it's just simply, on this first one, it's just pulling from above where the normal interest rate is, but all these subsequent interest rates are simply pulling from the cell immediately above it. Okay? Now, this is not ideal because if you're doing an adjustable rate mortgage, what this would do, in essence, you'd start out with whatever your normal rate is, let's say 5%, but then you say, okay, we're going to adjust it in month 6 to 7%. Okay, so you see what's happened is now, from that point forward, everything is 7%. Okay, you want to change it again. And let's say in month, I don't know, 16, we want to change it to 8%. Okay, and it changes it from that point forward all the way down. Now, the downside of this is to change it back, you've got to go back and now you've got to replace where you've made those two little changes, the formula. So for example, like right here where we made the change from 7% to 8%, right now that's hard-coded with just 8%. So in order to change it back to where it changes with what was right above it, you just simply hit equal and then drag the cell 1 up and hit enter. This thing is slow as Christmas. Whatever it is. There we go. Okay, so it puts it back at 7%. Then we go back up here where we made the other change, same thing. Okay? So now everything's back to where it was. But the point is, you can go through literally month by month, year by year, and change the interest rate so that it is truly an adjustable rate mortgage model, okay? It's a little messy in the sense that you got to go back and subsequently make the changes. My advice to you would be to obviously save a clean version of this, and then if you make a whole bunch of changes, then you can always revert back to the clean version that doesn't have all those subsequent changes, okay? All right, now, we'll finish up one little thing, and then we're done. But just to kind of put things back to sort of the way they were. Okay, so we get the 877.57, and then with the modifications of the term that we pay off in, and the prepayment penalty fees and all that, ultimately what we show, 12.5% lender's yield on a 10% loan. But once again, we can go in and change those to whatever we want. And so making whatever those changes are, changing the prepayment term, I mean, you can play around with this to your heart's content and see how much of an impact each of those little changes will have on the overall lender's yield, to be able to, if you're looking at it from the lender's perspective, how can I maximize that return? Looking at it from the perspective of the borrower, how can I potentially minimize it? Okay? Make sense? Okay. I think that pretty much takes care of all of that. Okay, so one thing before we finish up, before I forget, and this is a good thing. Yep.
Question. Well, when would we start seeing these type of examples in the analysis or investment side?
You're going to see them it mixed in with the investments course, mixed in with the financial modeling course, mixed in, even to a certain extent, some of the Argus stuff. Okay. All right, any questions for one final announcement? Okay, so the quiz is obviously up and available, ready for you to do that whenever you get to it until Monday. All right, so one of the things that we have been strongly encouraged to do by the dean is to get everybody to fill out their course evaluations. And so what I'm going to do is I'm going to incentivize it. But my incentive, like all things I do, is strange. Okay? So basically, you're going to get automatically 1 point added to your course grade, your final course grade, by filling out the evaluation. If 90% of the class fill it out, you're going to get 2 points.
Y'all better fill that out.
Fill it out.
If 100% of you fill it out, you get 3 points.
All of you. All of you.
So this is peer pressure time. Now, this has nothing. Now this has nothing.
For all those people that
This
are
has
not on.
nothing to do with what you say. You can say all the horrible things you want to say about me. That's not the point. The point is to fill out the evaluation so that we have a reasonably accurate representation of people that are enrolled in the classes. Because what happens, and I know that you guys know this, in a lot of classes, less than 20 or 30% of the people actually fill out the evaluations, and that's not a whole lot of information to go off of, okay? And so, I don't care what you say. You can say good things, you can say bad things, you can say nothing at all. My preference would be that you offer up, thoughts, comments, observations that you think would be helpful, okay? And you can write as much as you want, you can just bubble in the circles. I don't really care. I'm offering up, though, the incentive to get it done and to have 100% participation. Now, keep in mind, it closes tomorrow. So if I were you, I would do it now and get it over with. I won't see the evaluations, obviously, until grades are turned in and all that sort of thing. So it's not like I'm going to go poking around there, and I can't even see who turned. I can see who turned in an evaluation. I can't see, obviously, what they turned in.
We don't need to submit it on Canvas or anything like that?
No, what I will be able to see is, I will be able to see